Ever wonder why you're working so hard to earn money? Is it just to pay the bills, or do you have a grand vision of building your wealth? Let's be honest, we all have dreams and aspirations, and more often than not, they require financial backing. Having a clear financial goal is not just a good idea, it's an essential part of achieving those dreams. Now you might be thinking, I'm not a millionaire, how can I possibly start investing? Here's the thing, investing is not an exclusive club for the wealthy. It's a journey that can be started by anyone, at any stage in life, and it's one of the most effective ways to build your wealth. So, let's get into it. We're going to break down the 10 golden rules of investing, rules that can guide you, whether you're just starting out or looking to enhance your investment strategy. So why do you want to build your wealth? Keep that answer in mind as we delve into the 10 golden rules of investing. Rule number 1, investing is essential for wealth building. Now, let's break this down. What is investing? Simply put, it's the act of committing money or capital to an endeavor with the expectation of obtaining an additional income or profit. And why is it essential for wealth building? Well, because it allows your money to work for you. Imagine you're saving money in a jar. Each day you put $1 into it. Over time you save, let's say $1,000. That's great. But what if that jar could magically turn your $1,000 into $2,000 or even $3,000? That's essentially what investing can do. It's like a magical jar that has the potential to multiply your savings. Just saving money is like running on a treadmill. You're moving, but you're not going anywhere. With investing, it's like running in a marathon. It's a long race, but there's a finish line, a goal. And that goal is wealth. Think of investing as a seed. When you plant a seed and nurture it, it grows into a tree. That tree then bears fruit which you can eat, and if you plant the seeds from that fruit, you can grow more trees. This is the power of investing. Your money is the seed, the investment is the tree, and the returns are the fruit. But it's not just about wealth in terms of money, it's about financial freedom. It's about having the means to live the life you want. It's about being able to support your family, to travel, to retire comfortably. Investing can help you achieve all that. However, it's important to remember, investing comes with risks. The tree you plant might not bear fruit, but that doesn't mean you stop planting. You learn, you adapt, and you plant better seeds. That's the beauty of investing. It's not just about the destination, it's about the journey. Remember, investing is not a luxury. It's a necessity for anyone who wants to build wealth. Rule number 2, start investing early. Imagine a snowball rolling down a hill. As it moves, it accumulates more and more snow, growing larger with every roll. This is essentially how compound interest works, and it's one of the most powerful tools in an investor's arsenal. When you invest money, you earn interest on that money. But what makes compound interest so powerful is that you don't just earn interest on your initial investment, you earn interest on your interest. This might not seem like much when you're starting out, but over time this compound interest can translate into significant growth in your investments. Consider this. If you start investing at the age of 25, and you put away $200 a month until you're 65, with an average return of 7%, you'd end up with just over $1 million. Now if you wait until you're 35 to start investing the same amount, with the same return, you'd only end up with less than half, just over $400,000. That's the power of starting early. The earlier you start investing, the more time your money has to grow. Even small amounts can add up over time thanks to compound interest. And the longer your money is invested, the more potential it has to overcome the inevitable ups and downs of the market. It's never too late to start investing, but the earlier you start, the more potential your money has to grow. So, whether you're in your 20s, 30s, or beyond, take the plunge and start investing. Your future self will thank you. Time is on your side when you start investing early. The earlier, the better. Rule number 3, diversify your portfolio. Let's delve into this a bit. Diversification is a strategy that mixes a variety of investments within a portfolio. The rationale behind this technique contends that a portfolio constructed of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Think about it this way. Imagine you're at a buffet. Rather than piling your plate with just spaghetti, you'd want a little bit of everything, right? Some salad, a slice of roast, some sushi perhaps, and let's not forget the dessert. That's exactly how diversification works. You spread out your investments across different asset classes to reduce risk and enhance potential returns. So, what does a diversified portfolio look like? Well, it typically includes a mix of stocks, bonds, commodities, and cash. Stocks offer high potential returns but come with high risk. Bonds, on the other hand, are generally more stable but offer lower returns. Commodities like gold can act as a hedge against inflation, while cash offers liquidity and safety. Yet, diversification isn't just about spreading your investments across different asset classes. It also involves diversifying within each asset class. For instance, if you're investing in stocks, don't just buy stocks from one company or one sector. Spread your investments across different companies and sectors, and remember, diversification doesn't guarantee profits or protect against loss in declining markets. It's a strategy aimed at managing risk. By spreading your investments, you're less likely to suffer a major loss if one of them goes south. So let's go back to our buffet analogy. If you only pile your plate with spaghetti and the spaghetti turns out to be bad, you're left with a dissatisfying meal. But if you have a variety on your plate, you can still enjoy the meal even if one dish isn't up to par. Don't put all your eggs in one basket. Diversify your portfolio to spread the risk. Rule number 4, understand your investments. Now, this rule might seem obvious, but you'd be surprised at how often it's overlooked. Investing isn't just about buying low and selling high. It's about understanding what you're putting your money into and why. You wouldn't buy a car without knowing what's under the hood, right? The same principle applies here. It's easy to get caught up in the hype of a hot stock or a trending asset class. But remember, trends can come and go. What's hot today might be cold tomorrow. And if you're investing based on hearsay or a gut feeling, you could end up holding the short end of the stick. That's why it's crucial to do your homework. Research the companies or assets you're considering. Understand their business models. Look at their financials. Scrutinize their management teams. Consider their competitive landscape. And don't stop there. Keep up with the news. Stay on top of industry trends. Regularly review your holdings. The more you know, the better equipped you'll be to make informed decisions. Now, this might sound like a lot of work, and it is. But remember, you're not just investing your money, you're investing your time and energy too. And the more you put in, the more you stand to gain. So don't just follow the crowd. Don't just chase the trends. Understand your investments. Know what you're getting into, and why. Because when it comes to investing, knowledge isn't just power. It's profit. Knowledge is power. Understand your investments to make informed decisions. Rule number 5, minimize fees. You see, fees are like termites to your investment portfolio. They may seem small and insignificant, but over time, they can eat away at your returns, leaving you with far less than you anticipated. Now, you might be thinking, well, how much can a small fee really impact my portfolio? Let's put it into perspective. Let's say you have an investment portfolio worth $10,000. If you're charged a seemingly small fee of 1% annually, that's $100 you're losing every year. But here's the kicker. It's not just $100. It's $100 plus all the potential gains that money could have earned if it had stayed in your portfolio. Over 20 years, that could amount to thousands of dollars. Now that's not so small, is it? So how do we minimize these pesky fees? First, understand what you're being charged for. Fees can come in many forms: management fees, transaction fees, performance fees, and so on. Make sure you're aware of all the fees associated with your investments. Once you know what you're being charged, shop around. Different investment platforms and financial advisors offer different fee structures. Some might offer lower fees but have less comprehensive services. Others might charge a bit more but provide valuable advice and resources. Consider low-cost index funds and ETFs. These types of investments typically have lower fees than actively managed funds. They're designed to track a specific market index like the S&P 500, and because they're not actively managed, they come with lower costs. Lastly, negotiate. Yes, you heard it right. Some fees are negotiable. It doesn't hurt to ask if there's any wiggle room on the fees you're being charged. Remember, every dollar you save on fees is a dollar you can invest. Be mindful of the costs. Rule number 6, be patient and consistent. It's easy to think of investing as a sprint, a race to accumulate wealth as quickly as possible. But in reality, it's more akin to a marathon, a long-term endeavor that requires patience, consistency, and endurance. The world of investing is not a casino. It's not about placing bets and hoping to hit the jackpot. It's more about planting seeds and patiently waiting for them to grow. Yes, there will be seasons of drought and storms that may shake your investments. But it is during these times that patience becomes crucial. It's about understanding that the journey to financial growth is a gradual, steady climb, not a rocket ride to the moon. Consistency, on the other hand, is the fuel that keeps this journey going. It's about regularly contributing to your investments regardless of the market conditions. It's about sticking to your investment plan, even when your emotions or the latest market trends might be telling you otherwise. Think of it as a fitness regimen. You don't get in shape by hitting the gym once in a blue moon, you get in shape by consistently working out, even on days when you don't feel like it. And just like with physical fitness, financial fitness requires the same commitment and discipline. So remember, when it comes to investing, quick wins might be tempting, but they are not sustainable. The real winners in the investing game are those who play the long game, those who understand the value of patience and the power of consistency. So if you find yourself anxious about your investments, or if you're tempted to deviate from your investment plan, take a deep breath, remind yourself of your financial goals, and stay the course. Remember, Rome wasn't built in a day, and neither is wealth. Patience is a virtue, especially in investing. Stay the course and be consistent. Rule number 7, regularly review your portfolio. This, ladies and gentlemen, is the essence of staying in tune with your investments. You wouldn't drive a car without occasionally checking the rearview mirror, would you? The same principle applies to your financial journey. Now, let's break this down. Regularly reviewing your portfolio means assessing the performance of your investments, taking into account changes in market conditions and your personal financial goals. It's about asking yourself, are my investments still aligned with my objectives? Are they performing as expected? Have any significant changes occurred that might necessitate a shift in strategy? Certainly, the stock market isn't static. It's a dynamic entity that ebbs and flows with the tides of the global economy. Companies rise and fall, sectors evolve, and macroeconomic factors shift. As such, it's crucial to keep an eye on these changes and understand how they might impact your investments. But remember, reviewing doesn't mean constantly tinkering. Resist the urge to react to every market blip. Instead, set a schedule for reviewing your portfolio, be it quarterly, semi-annually, or annually. This disciplined approach can help you avoid impulsive decisions while keeping you informed about your investment's progress. Moreover, these periodic reviews are a golden opportunity to rebalance your portfolio. Let's say one of your investments has done exceptionally well and now represents a larger portion of your portfolio than initially intended. It might be wise to rebalance, selling some of those shares and reinvesting the proceeds into other areas of your portfolio to maintain your desired asset allocation. Remember, the goal here isn't necessarily to chase the highest returns, but rather to ensure that your portfolio continues to reflect your risk tolerance, investment timeline, and financial objectives. So, there you have it. Investing is not a set-and-forget strategy. Regularly review your portfolio to stay on track. It's like a financial health checkup, and believe me, it's worth every minute of your time. Rule number 8, use dollar cost averaging. Now, you might be wondering, what's dollar cost averaging? Well, it's an investment strategy where you consistently put the same amount of money into a particular investment at regular intervals. Here's a way to understand it. Imagine you have $100 to invest each month. Sometimes the price of the investment is high, sometimes it's low. But no matter the price, you're spending that $100. So when prices are high, you buy fewer shares, and when prices are low, you buy more shares. Over time, this strategy can lower the average cost per share of your investment, hence the term dollar cost averaging. So why is this strategy beneficial? Well, first off, it mitigates risk. You're spreading out your investment over time, which can reduce the impact of price volatility on the overall cost of your investment. Secondly, dollar cost averaging can potentially increase your returns. It takes advantage of the fact that market prices fluctuate. When prices are low, you're automatically buying more shares, and when prices rise, those extra shares can lead to greater returns. Now remember, while dollar cost averaging can help manage risk and potentially boost returns, it doesn't guarantee profit or protect against loss in a declining market. It's always important to consider your financial situation and risk tolerance before deciding on a strategy. Dollar cost averaging is a simple yet powerful investing strategy. Make it work for you. Rule number 9, don't panic over market fluctuations. Picture this, you've just invested in the market, and the very next day prices nosedive. It's enough to make anyone's heart drop. But here's a golden rule to remember. Don't panic over market fluctuations. You see, the financial market is a living, breathing entity. It rises and falls, ebbs and flows, just like the tide. It's influenced by countless factors, from geopolitical events to corporate earnings reports, from natural disasters to technological breakthroughs. It's simply the nature of the beast. Think of market fluctuations like waves in the ocean. They're inevitable, but they're also temporary. The tide that's out one moment is back the next. Similarly, a market downturn today could very well lead to an upswing tomorrow. Now, this doesn't mean you should ignore market trends. On the contrary, keeping an eye on them is part of being an informed investor. But it's crucial to differentiate between short-term market noise and long-term market trends. Let's put it this way. If you're on a long journey and you hit a bump in the road, you wouldn't turn around and head home, would you? Of course not. You'd continue on your path, knowing that the journey is more important than the temporary discomfort. The same applies to investing. Reacting impulsively to market fluctuations can lead to regrettable decisions. Selling off investments during a market downturn, for instance, often results in locking in losses. Instead, maintaining a steady course can be a more prudent strategy. Of course, this doesn't mean you should never adjust your strategy. It's just that these adjustments should be based on careful thought and analysis, not knee-jerk reactions to market volatility. In the end, successful investing is less about predicting market fluctuations and more about managing your reactions to them. It's about maintaining your composure, staying focused on your long-term goals, and making thoughtful, informed decisions. The market will fluctuate, but don't let it dictate your investing strategy. Stay calm and carry on. Rule number 10, consider working with a financial advisor. The world of investing can be complex and daunting, especially for those just starting out. This is where a financial advisor comes in. They can provide invaluable insights and guidance tailored to your unique financial goals and circumstances. They can help you understand the risks and rewards of different investment options, and they can assist you in crafting an investment strategy that aligns with your goals, risk tolerance, and time horizon. Furthermore, a financial advisor can help you navigate through the volatile waters of the market, helping you to stay level-headed during market ups and downs. They can also help you minimize fees and maximize returns, providing a comprehensive view of your financial picture that can lead to better decision-making. Remember, investing is not a solitary journey. It's okay to ask for help, and it's okay to seek the expertise of a professional. A good financial advisor can guide you on your investing journey. Don't hesitate to seek professional help if needed. So there you have it, the 10 golden rules of investing. We've journeyed from understanding the pivotal role of investing in wealth creation to the importance of starting early. We've discovered the power of diversification, comprehending our investments, and minimizing fees. We've learned about the virtues of patience and consistency, the necessity of regular portfolio reviews, and the effectiveness of dollar-cost averaging. We've also explored how to keep cool during market fluctuations and the potential benefits of working with a financial advisor. Each rule holds its own key to unlocking your financial growth and prosperity. Remember, investing isn't just about making money, it's about securing your future, realizing your dreams, and creating a legacy. If you found this video helpful, please give it a like and subscribe for more financial tips and advice. Remember, your journey to wealth starts with knowledge. So, keep learning, keep investing, and see your wealth grow.